Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to walk through Twitter, see what they're talking about, see what news is going on. It's going to be commodity related, financial stock market related, or wealth building related topics. I'm going to interject my financial opinions across the board as we go through it together. And again, if you want to follow me, it is at finding_finance, or you can join the community at finding-value.com, where we talk about individual companies on our Discord channel, also on our Platinum question and answer sessions and midweek updates. And use the word discount if you want to join. So, game of trades. Personal savings have plummeted following C19. It's now at the lowest level since 2013. With credit card debt and interest rates at their highest levels, consumers now face major headwinds. So these charts, they all kind of mimic the big boom and bust cycles. We were building up here, and you can see we went up into a bust of a cycle, which means that personal savings went to a very high rate in 2020. And you can see that double top. That is the same double top. If you look at this in some detail, I think it's going to be something similar to what we might see in the technology stocks. But we've come on down. It looks like it's stabilizing, much like the lumber chart, much like any other chart there is, and it's stabilizing down here for personal savings. When we see this go down, it means savings are being deployed into the economy. It's actually a positive thing. It's negative or somewhat negative when personal savings go up. What it means is people could get afraid, they're saving more money. It could be a slowdown. So when people look at this, I think they look at it backwards. Generally speaking, when this goes up, you've got a problem, and when it goes back down, you've got kind of a boom going on. So if we were to go sideways to slightly higher, we could see a slowdown in the economy. And I think people could also be saying, I need to save more money. Saving more money means that money is not going through the system. It's getting stuck into savings accounts or bonds or wherever else. I've got a couple of sayings here. So the best investors share a lot of the same traits. Here are a few. They identify value gaps in the markets and invest in the undervalued companies and stocks. These stocks typically make money and have earnings. They almost all have long time frames. They don't time short-term market movements or make predictions. They are more fearful of not being invested when the valuations are good. Um, the game taught me the game, and these are the things that I have tried to adopt into my own investing. So if we were to read a couple of these, it says, as Buffett has often observed, value investing is not a concept that can be learned and gradually applied over time. It is either absorbed and adopted at once, or it is never truly learned. So this is about value investing. Since the basic game is so favorable, Charlie and I believe it's a terrible mistake to try to dance in and out of it based upon the turn of the tarot cards, the predictions of experts, or the ebb and flow of business activity. The risks of being out of the game are huge compared to the risks of being in it. I've talked about this on the website a lot. This exact thing. I said, I am more afraid of not being in something than being in it. I prescribe that as a trait of understanding value. And I think Warren Buffett, it seems like he's got the same type of paradigm or outlook, or maybe I have the same paradigm or outlook as he does. I didn't really learn that. It was just a trait that made sense to me from a logical perspective. If the value is ultra good, if we're at ultra cheap value land, why would I not buy it? I know a lot of people, they try timing the markets. I see it all the time in the comment section. We're going to have a recession. I should go to cash. I should do this. I should do that. And you know what I do? I do nothing. I bought I bought a lot. I oversized positions at the bottom of 2020. I've been holding ever since. Yes, I've moved a little bit of money around to balance out the portfolio a little bit because I'm ultra heavy into oil and gas. But I continue to hold and I continue to add to the positions because the ratios are still at incredibly cheap levels compared to history. So I'm trying to adopt what these guys are saying, but I'm adopting it because the game taught me the game. The game told me, do not trade in and out. I got punished when I tried doing that. And I know people say, oh, you just need to become a better short-term trader. Short-term traders don't make any money, guys. I'm a huge amount since 2020 because of the lessons I learned in the mid 2000s. I'm not repeating those same mistakes. And everyone thinks that they can trade this stuff on the short term. Everyone's emotions move up and down based off of their account values and or the price of the stocks that they're looking at. They're negative when the price goes down. They're positive when the price goes up. And you know what you have to do? You have to change your mindset to think the exact opposite of what I just said. You need to be aggressive when the prices are low and you feel like crap about the stock, when the sentiment is bad, when your sentiment is bad. The game hasn't taught you the game yet, or you haven't learned the game. The game is to cost average in and get the cheapest, most amount of shares as possible at the best valuations. If a fair value of a Ferrari is $250,000 and we can buy it for $50,000, well, why don't we take that deal? But someone's going to say, well, a recession is going to come and the Ferrari could trade at $35,000. Well, maybe we save up money and we buy two Ferraris. We buy one at 50 and one at 38 or whatever it gets to. We don't know the future, and that's what makes investing difficult is everyone they think they know the future. What these guys are doing is they're identifying that value gap between the 250 and the 50 and say, you know what? It's a big enough value gap. I'm accepting it. I'm going to continue to accumulate assets at that price. Peter Lynch, why you should always ignore economic predictions. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. You just have to accept that you are going to be down in some of the positions that you enter, especially almost every position that you enter. You're not going to perfectly time the bottom. At some point, you will be down in a position in almost every single position that is created. Think about that for a second. Every single position that you enter will most likely be down at some point. It could be that the end of that day. It could be the next day. It could be a few days away. It could be a week, a month, 2 months, 5 months, 6 months. You could be buying it when it's volatile. There's a high likelihood that you will be down in the position at some point. And that's part of the game. Coming on back, I've got a couple of tweets here. So one of them says, if you're trying to read market conditions, the big macro picture, you must be able to read data correctly and ensure you are reading the right data that leads all the other data. I see a lot of people having no idea what data to look at and which data is leading or lagging. They also don't know what data drives it all. You cannot accurately put the statistical odds in your favor if you have no idea what drives what. So we've got a lot of people and they'll be pointing at things. They'll say, oh, unemployment went up. Okay, is that significant? No, maybe. Well, what's the threshold of unemployment? When should we be worried? When should we worry about inventory of real estate? Is the rate of change what matters? Is it the absolute value that matters? If you're at an inventory level that's almost zero and you go up 100%, people are going to say it went up 100%. It's crashing. The housing market's crashing. Well, if you went from 0 to 1 month of total absolute inventory, that's not crash level. That's really low in a seller's market. So who should you believe? Why should you believe it? Why is that information important? Those are the questions you should be asking, and those are the things that you should be seeking to answer. The reason is if you know the answer of why, then you can hold on to the stock or you can hold on to the company. Hey, I just bought, and I'm just making this as an example. Hey, I just bought a bunch of natural gas companies. Well, why'd you buy it? Well, I bought it because the ratios are dirt cheap. The technical chart patterns are starting to turn up. Things look like they're strengthening. The companies are making money. The companies are cheap themselves to their cash flows. The companies are cheap in relationship to natural gas prices on a historical basis. You've got this entire data of why you're buying it. Now, just because you've got all this data of why you're buying it doesn't mean it has to go higher. It just means that you're increasing the probabilities of your success, and you're doing it and playing the game the same way that Warren Buffett and all these other guys are doing it. That is what it means. And that is how you become a successful investor. You have to figure out the traits that you need to learn and implement those traits to become successful. Here's another one that I shared. It says one of the largest disconnects between making money and losing money seems to be time frame of outcome, or you can say it's patience. Lots of insanely good investors identify good value in the market, buy shares, and wait for that valuation to change over time. What they're waiting for is a different market condition or a fear to subside or some other reason why. It could be a restaurant company like Chipotle. They had E. coli scare, which drove their shares down 50 or 60% from their highs. That was an exceptional time to buy it. It was $300 a share. The stock's now trading over 2,000. Those are the opportunities that you need to figure out and find and then capitalize on. It says most people let the game beat them even when everything is saying it is good to go. They're beating themselves because the patience or their time frame of what they expect an outcome to be is not what matches the market. You have to match the market. You can't play the game to your wants and needs. You got to play the game that's in front of you and that the game is. You can't change that game. The game's going to be the game. The herd's going to be the herd. And they're going to do the things on their time frame. What you're going to find out is the market moves very slow to what people think it can move. It is very, very slow. And that's where you have to slow things down. Now, here's Henry Hub natural gas. I was just talking about natural gas. It says weekly price momentum oscillators turning up and coming off the lowest level in history. Natty gas bulls must be licking their chops here. Damn right we are. It's starting to turn around. It's at a very low level. We've got, I don't know what this is, probably like a relative strength indicator, MACD or whatever it is. It's starting to come on up and it's at the lowest level it's basically ever been. And we're in what I think is a large commodity bull market. Natural gas is a building block of the economy. It is very important to the economy. If you look, there's an uptrend in natural gas here, an overall downtrend in natural gas here. And what you should be looking at is look at these lows. You have lower lows as you come in, and what do we have here? A higher low. That is important because this is the beginning of an uptrend. It started here at 2020 when I bought a whole bunch down here. Guess what do you think I'm going to do again? Buy a bunch down here. I'm going to be patient. I'm going to wait for this bull market to materialize and make me very, very wealthy, hopefully. And you guys can obviously subscribe to the channel or the website, and you guys can follow what I'm doing. I can coach you through it if necessary. Can't give advice, but I can tell you what I'm doing. You'll see what I'm doing. It says, without comment here, Brent crude with inflation adjusted chart, he's got an overlay of it. Now, these things don't match perfectly, and they're not, and the time frames could be off a little bit. But I do think that Pierre Andrand is right on a longer time frame. He is right. You can't get too aggressive with too much leverage, because if you're wrong on your time frame, leverage will kill you. It says, you heard it here, folks. The Permian Basin is depleting faster than we thought. And that was Goring and Rosenzweig. So what do you think I'm going to do? We've got natural gas real cheap. We've got oil that's incredibly cheap against gold, 28 to 1 ratio roughly, 27, 28 to 1. And all we have to do is buy these cheap assets and wait for the supply to level off or start to decline with demand increasing. And if the market conditions are right for money to want to rotate, increasing interest rates, money rotating out of bonds, eventually money will rotate out of stocks, and maybe we're slightly early. Maybe we're 6 months to a year early. That is possible, where this gets delayed a little bit. And maybe we're not. Maybe it's going to take off immediately. But all you have to do is kind of wait. If you know the market conditions, just wait, be patient, accumulate when things are cheap. Here's John. He's got URNM divided by the Sprott Physical Uranium Trust. What we're looking for is an outperformance. We're starting to see URNM outperform the Sprott Physical Uranium Trust, and we could see a big move. What does that mean? Under those conditions, when URNM outperforms the Sprott Physical Uranium Trust, that is when we see fireworks. That's the uranium bull market. Hopefully that continues. It says by 2024, Middle East supergiant oil fields will be over 60 years old, declining at 8% or more per year. If the Permian peaks, as many think it will, with shale's brutal decline curve, we're at Marion King Hubbart's peak for world oil production. If you understand this, and I don't know if we are, I don't think anyone's going to know with 100% certainty. I don't even think they're going to know with 50% certainty. But if we are close, anywhere close to a peak or a flattening, leveling off of production, what's going to happen is we're going to experience something like the 1970s all over again on a worldwide basis. And you know what happened? You know what performed incredibly well during that time frame? Precious metals did, because people got scared of currencies. The reason they got scared of currencies is because GDP wasn't growing at a fast enough pace as the money supply was. And I think a similar dynamic is coming up to that type of dynamic in the markets. If that is the case, we can invest directly in energy if that's where the root cause of the problem is. And we could look at metals, precious metals, physical metals, and all those things, royalty companies, on the likes of that, to benefit from a potential currency scare like happened in the late 1970s. I think gold went up 23, 4, 5x, I think, something like that, and silver went up 50x. 50x, the physical metal itself. What is your risk reward there, guys? Think about that. The risk reward of silver, it went up 50x, and what is your risk? Pretty stinking low. I think that's pretty good. And platinum's another one that I really like. I like platinum and silver, my favorite. So it says this. So this is good, right? Natural gas. Haynesville rig count down 6 to 44 versus 69 a year ago, and you can see the rig count declining because natural gas price is too low. Eventually, we're going to get these big swings back and forth with rig counts, demand, and supply. And then we've got oil's getting very close to breaking out here, which if oil breaks out, we've got natural gas also firming up and starting to round into a bottom. Well, what do you think I'm going to do, guys? And it's cheap. You just buy it. That's what I'm going to do. I'm just going to buy it and hold on. It's not that difficult. And I know a lot of people, well, what about a recession? We could have a recession. Ride through it. Don't time it. What if we don't have a recession? What if we don't have as big of a slowdown as what people think? What if the slowdown's already behind us? A lot of the data that we're looking at is lagging. The stock market and a lot of these things are forward-looking 12, 18 months. So they're looking forward 12 to 18 months. Maybe everything is discounted in those lagging indicators that people are looking at. Maybe not. We don't know the exact outcome. The question to ask yourself is this: can you be patient? If the answer is yes, then you ask the next question: are things underpriced? If they're underpriced, okay, it looks good. What's the technical analysis looks like on it? Well, they look pretty good, and they look like they all want to break out. That's all you can go off of, guys. If the technicals look good and you've got good valuations and the market conditions are right for this to happen, I'm not going to be sitting on the sidelines. I'm going to be in it, riding it, and just waiting. Now, some people say, well, that's a bad thing. You could lose money. Don't sell. Just hold on to the assets. Guys, you know how these billionaires play this? They don't time the market like that. These billionaires build companies that take years and years and years, and they invest their wealth into these companies. You think Steve Jobs was buying and selling Apple stock as it was going up? No, he just held on. You think Elon Musk was doing that? No, he just held on and then bought at the top or sold at the top. He sold a bunch at the top up there. You think a lot of these guys are buying and selling a bunch of stock? They can't. They can't. If you own 20, 30% of a company, you can't buy and sell out of it. So if they can't, if all the billionaires can't, and they're making billions of dollars, well, why can't you do what they do? It's very similar. It's a similar game. They're buying things when they're cheap, and they're selling it when it's expensive. And they've got the correct time frame, which is a long time frame. That's exactly what I'm doing. If we are actually hitting a peak in oil, how valuable do you think oil is when it becomes pretty scarce? Think about how much work does it take to go dig a hole in your backyard, and how quickly can you do it with a bobcat and a couple gallons of fuel? It is so undervalued. the the work content that is able to be created and the mechanization of things from gasoline and natural gas and all these different fossil fuels. It's mind blowing to me. But that's what I'm going to end on with. Give me a thumb up for the content, subscribe to the channel, and we do have a 5 p.m. Mountain Standard Time, 5 p.m. Mountain Standard Time Sunday. It's Sunday today. Question and answer session. So see you guys there, and hopefully everybody's having a good day. Hopefully you guys are having a good weekend because I know July 4th is coming up. So don't hit it too hard. All right, guys. We'll see you later. It's finding value.